the fears over the new Trump administration and what tariffs mean. And that has pushed the dollar higher and rates higher. And this whole thing is the exact same setup, and you and I have talked about this, of the dollar and rates in 2016-17. With the same set of Trump outcomes and tariffs and the same policies, it did the same thing. The first thing Trump did when he got into office was say, I want a weaker dollar. And he's already said rates are too high. So they're not stupid. They also know that they've got debt to roll, that they also have trade negotiations to do. So my view is they will use the stronger dollar as a carrot and a stick, which is China, you're going to have to devalue your currency unless you play ball with us. But if you do play ball with us, we will inject liquidity into the dollar system. We will lower the dollar. We will jawbone it lower. And you can then stimulate your economy, because the Chinese cannot stimulate right now without risking a breaking of the yuan peg, which they don't want. So I think it's all part of the Trump trade negotiations. And we know that the teams have already been kind of speaking to the Chinese and the Europeans and everybody else. When you go back to Besant, who I know decently well, Scott has made it clear that the dollar is too strong and that he would want a weaker dollar. You know, lower oil, weaker dollar. They want easy financial conditions because they want to win the midterms. And that's a big thing. Then there's the new guy who's coming in. I can't remember, Felix from Blockworks interviewed him. Can't remember his name, the Economic Council guy. Stephen
Buran.
Yeah, very interesting interview. And Stephen spent half the interview talking about at some point we're going to need a Plaza Accord if this continues, but we are going to have to get the dollar lower. Now, I don't think the Plaza Accord idea is this time around. I think it's probably closer to 2030 that people are just going to go, we can't deal with this dollar. Now, the dollar is structurally strong because the world is 50% in debt in dollars, and there's a shortage of dollars. The moment the US takes liquidity out of the system, it's a game of musical chairs, and it drives the dollar higher. So, you know, people will bid up for dollars. So that's where we are. We've also, as you talk about a lot, we are waiting for the injection of liquidity that comes as the reverse repo redrains back to zero, then probably the end of QT, and then the draining of the TGA. Also in the Fed minutes, sorry, I'm trying to get across a lot here. Also in the Fed minutes, the previous minutes, they had talked about that they're not keen to rebuild the TGA immediately afterwards and have a tightening of financial conditions. So what does that mean? I mean, either there's another way around it, or as you possibly suggested, it could mean QE, which sounds ridiculous now, but who knows? The other thing that this financial conditions is doing is pushing down forward growth expectations. And so it starts to make you think Q1, Q2 might be weaker, and that gives the Fed more cover also to cut rates. So this is from the January GMI. This chart at the top is, let me just get rid of that. This chart at the top is global M2 last time around versus this time around. And global M2 last time around, this time around, it's identical, which is kind of weird. Then we also have beneath it is the chart of the NASDAQ, and that's pretty much identical. So we have a repeat in the monetary conditions, global M2, because the dollar was strong. That's what's pulling back global M2. It also caused markets to readjust. When we look at Bitcoin, we can see the phasing's out, but when you kind of match up the phasing, what happened, it was the 4th of Jan, we had a correction like we're having now, and then Bitcoin went up. And once you match the two, you kind of get a very similar pattern. So what we've got is, and also here's the economic surprises index and the DXY. It's been coming lower. It should drag the DXY, change rate expectations. Julian just put out a tweet this morning about all of that. So everything is here. Fed cuts may change because there's now 25 basis points priced in. Okay, as a risk reward, there's a decent chance we get something. So it's like all the factors are in play, and whether the market sniffs it out or not, I mean, we got another week until whether we get fuller announcements beforehand or we have to wait for the inauguration and stuff. I don't know.
Julian Biddle is the head of global macro research at Global Macro Investor, Raoul Pal's monthly advisory publication, providing in-depth global macro analysis and actionable trade recommendations for investors. His analysis of the intersection between macro and crypto is quite similar to Powell's. In a recent post on X, Julian discusses the dollar wrecking ball and how he believes it get capped in the coming weeks. The tweet reads, "The dollar wrecking ball is in full swing here. The dollar's rapid rise over the past couple of months has massively tightened financial conditions. This sharp move is already taking a toll on U.S. economic surprises. Economic surprises have already pulled back from their peak levels in November and are likely to continue drifting lower over the near term. This is exactly the kind of lagged impact we'd expect from such a rapid tightening in financial conditions." In his post, Julian adds that this bad news might play out for a little bit more time, but it would eventually give room for the good news. The rest of the post reads, "This setup is exactly what I believe will pave the way for the Fed to step in and begin easing rates further soon, despite the prevailing narrative floating around for zero cuts in 2025 and the forward curve currently pricing in just 28 basis points for the whole year. However, the conditions for a shift towards easing are already falling into place. So here's how I see it playing out. The dollar and yield surged in Q4, creating a significant tightening in liquidity conditions. Now with the lag effect kicking in, weaker economic surprises are emerging, and as those continue to deteriorate, the Fed will have no choice but to respond. When that happens, we're likely to see the dollar's strength finally capped and the pressure from rising yields start to ease. This will then help alleviate the liquidity squeeze that's been building, giving risk assets the breathing room they need to rally again. During the discussion with Larson, Powell also talks about the aftermath of this expected liquidity boom, especially given that the inflation battle has not been completely won.
I don't think liquidity affects inflation, really. I think they're driven by different things. One is debasement, one is the price of goods and services, and I don't think they're necessarily driven by the same things. A lot of this is also the year-on-year base effect. So, and the central banks know that as well, which is why they've been saying, the Europeans, the US, everybody's kind of like, it's going to be a bit wiggly for a while. But overall, we still haven't fully deflated all the housing stuff that's back-end loaded in CPI. So it's going to be heavier than people expect. Also, we're expecting to see economic growth slow down somewhat. The SESI kind of says we're going to get weaker data. But, anything now, like the high yields now, plays into inflation in 6 months' time, 12 months' time, i.e. lower. So the answer to inflation is having bond yields what they're doing. I still think by the end of this, inflation will undershoot, not overshoot, because of the weird dynamics that caused by the pandemic and this lagging of housing and rates being so high for so long. It doesn't affect Microsoft and Apple and Google or whatever, but it sure as hell affects anybody on a variable rate mortgage or anybody who's borrowing money elsewhere in the economy. But it takes time. The other thing that a low ISM indicates to you is that household earnings and corporate earnings outside of the tech are somewhat stagnant still, right? So the feedback loop we haven't had yet, even though the economy has been growing at decent clip, the actual broadening out of economic growth with recycled earnings and profits hasn't really happened. So it's a very late cycle in that respect. The moment it does, it means that the structure of markets changes, small caps start doing better, alt season happens in crypto, it's all the same risk curve. Junk outperforms, all of this stuff starts happening the moment that happens. And we're still not there because of Fed rates, I think. I've just been surprised that the ISM has not followed the forward-looking indicators yet. But it feels like any month now, as you say, it's going to be up 6 index points and another 6. And then before you know it, you're in the mid-50s. And then you'll start to see it. And I think, obviously the Trump administration want that too, because they can't just be tech stocks that are winning. They want Main Street to win as well. And Trump in the end is a property developer. He understands the business cycle as well as anybody. I think everybody does. The Chinese, the Japanese, the Europeans, the Australians, the UK. I mean, everybody wants a weaker dollar. One thing I do know is Januaries have this lovely habit of blowing everybody up before the true trend establishes. In GMI, and I've been writing for 20 years, I've never made a trade in January because January always gives a conflicting signal. And so the signal now is, oh my God, the markets, rates, this is terrible. And usually what happens is it completely reverses sometime in Jan or Feb, and the market then sets its direction. So I never read into Januaries.
Powell's thesis is that Bitcoin and other cryptocurrencies will keep chopping around current levels for a few more weeks before the recovery phase begins. However, others believe prices could drop sharper as the correction continues before the recovery begins. Tom, the head of research at Fundstrat Capital, believes Bitcoin's price could do as low as $50,000 per coin before it begins to rally upward again. In a recent interview with CNBC, Lee explains that Bitcoin is currently about 15% down from its recent price peaks, a situation he describes as a pretty normal correction for a highly volatile asset. However, Lee points out that the market is still pretty early in the current Bitcoin halving cycle, meaning prices could drop lower in the coming weeks. He foresees a potential drop to 70,000, then maybe even 50,000, which he says will give investors a huge opportunity to buy the dip before the next leg of the rally begins. Do you agree with Powell's slow burn correction predictions or Lee's rapid drop correction? Or do you believe the cycle has already peaked and we won't see another Bitcoin all-time high in 2025? Don't forget to like and subscribe, and let's keep this bull run going.